Why invest in anything other than U.S. growth? This chart will change your perspective. For years, investing felt simple. Buy U.S. growth stocks, hold tight, and let innovation do the heavy lifting. The strategy worked. American tech giants dominated global markets, earnings expanded, and portfolios swelled. It became easy to believe that the smartest move was to keep doubling down on what had already won. Why look anywhere else when the U.S. seemed unstoppable? But what if the very success of U.S. growth is the reason investors should pause? A single chart comparing valuations, demographics, and global earnings growth tells a different story. It reveals a world that has quietly changed. U.S. stocks now trade at premium prices that assume near-perfect performance. Meanwhile, entire regions across Asia, Europe, Africa, and Latin America are growing faster, innovating rapidly, and trading at more attractive valuations. The question is no longer whether U.S. growth has been strong. It clearly has. Let's watch. 1. The U.S. market is expensive. Valuation matters. U.S. growth stocks have been on a decades-long upward trajectory, leading to historically high price-to-earnings ratios. Companies that once offered seemingly endless growth potential now trade at multiples that assume perfection. Even minor earnings miss or macroeconomic shocks can trigger significant volatility. Investors focusing solely on U.S. growth face a dilemma: pay a premium for continued exposure or risk missing out on global opportunities. Markets outside the U.S. often present better entry points. For example, emerging markets and select European equities offer compelling valuations relative to earnings and growth potential. While U.S. growth remains strong, a concentrated allocation increases portfolio risk. Expanding globally allows investors to buy high-quality companies at more reasonable prices. 2. Demographics favor emerging markets. The U.S. has a mature population with slow growth, limited workforce expansion, and increasing dependency ratios. In contrast, countries in Asia, Africa, and Latin America are experiencing younger, expanding populations. This demographic dividend is powerful. A growing middle class drives demand for consumer goods, technology, real estate, and financial services, creating new opportunities for investors. China, India, Indonesia, and Nigeria, for instance, have burgeoning urban populations and rising disposable incomes. Companies catering to these markets often grow faster than their U.S. counterparts simply due to population dynamics. Ignoring these regions means potentially missing out on the next generation of growth engines. A portfolio weighted solely toward the U.S. may perform well, but diversification into these high-growth demographics provides an asymmetric opportunity for long-term returns. 3. Global innovation is expanding beyond the U.S. Tech innovation is no longer exclusive to Silicon Valley. While the U.S. remains a leader in software, cloud computing, and AI, significant innovation is occurring across Europe, Asia, and Israel. Robotics, renewable energy, biotechnology, and fintech are thriving in non-U.S. markets. Companies in China dominate electric vehicles and battery technology. South Korea and Taiwan lead in semiconductor manufacturing, and Israel continues to produce cybersecurity and AI startups that rival U.S. firms. By investing globally, you capture growth that U.S. markets cannot offer. Limiting exposure to domestic equities means potentially missing transformative technologies, emerging abroad innovations that could reshape entire industries over the next decade. 4. Currency and economic cycles create opportunities. Diversifying globally isn't only about owning companies in different countries. It's about positioning your portfolio to benefit from shifting economic and currency cycles. The U.S. dollar has enjoyed long periods of strength, but currencies move in waves. When the dollar weakens, investments held in foreign currencies can gain additional value once converted back, enhancing overall returns for U.S.-based investors. Economic cycles also rarely move in perfect sync. While the U.S. economy may be slowing or battling inflation, other regions can be entering expansion phases. Europe's push toward green energy, Asia's large-scale infrastructure investments, and Latin America's exposure to commodity upswings create distinct growth timelines. 5. Risk management through diversification. No market rises indefinitely, and history consistently proves that leadership rotates. Relying entirely on U.S. growth stocks leaves investors exposed to risks unique to one economy. Changes in interest rates, tax reforms, regulatory crackdowns on technology companies, or escalating trade tensions can disproportionately impact domestic growth sectors. When portfolios are heavily concentrated, even temporary policy shifts or geopolitical shocks can create significant volatility. Global diversification helps reduce that concentration risk. Different regions operate under distinct economic cycles, policy environments, and currency dynamics. Emerging markets, Europe, and Asia-Pacific equities often respond differently during periods of stress, providing balance when U.S. markets struggle. Currency movements can also add a layer of diversification, sometimes offsetting domestic weakness. A globally diversified portfolio is not about eliminating risk entirely, it's about distributing it intelligently. By spreading investments across multiple growth engines, investors reduce the impact of any single downturn. Over decades, that risk management preserves stability, smooths returns, and protects the long-term compounding that ultimately drives meaningful wealth creation. 6. Opportunities in alternative asset classes. Investing beyond U.S. growth also means opening the door to alternative assets that traditional stock portfolios often overlook. Infrastructure, global real estate, renewable energy developments, and emerging market bonds can provide diversification, steady income, and exposure to long-term structural trends. Unlike high-valuation growth stocks, many of these assets generate consistent cash flow and attractive yields, which can be especially valuable in uncertain or shifting interest rate environments. 7. Long-term compounding requires a global lens. The most important reason to look beyond U.S. growth is simple: compounding thrives on diversification. Long-term wealth isn't built by concentrating everything in one market, no matter how strong its past performance has been. The global economy is vast, constantly evolving, and deeply interconnected. When investors allocate capital across different regions and asset classes, they tap into multiple growth engines instead of relying on just one. That broader exposure strengthens the power of compounding over time. If U.S. valuations stay elevated or economic growth moderates, returns could slow compared to the previous decade. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.